Hello and welcome back to our channel, Accounting, the Language of Business. Our goal is to educate our viewers and subscribers on all things related to accounting, finance and investment. Let us know if the content we are providing is helpful. We would love to hear from you. Today's topic is financial statement analysis. In this video I'll be giving an overview of how to analyze financial statements. This is the first in a series of videos on financial statement analysis. In future videos I'll take a look at how to analyze each of the main financial statements: the balance sheet, the income statement and the cash flow statement. Let's get into it. Financial statement analysis is the process of reviewing and interpreting financial statements to understand operating results, liquidity and financial condition, and to forecast future operating performance. Financial statement analysis requires going beyond the financials and examining footnotes to the financial statements, management's discussion and analysis, performing ratio analysis, red flag analysis, and reviewing external information such as analyst reports. Financial statement analysis is important for investors, lenders, the government, the public, management and employees. Financial statement analysis helps users interpret the impact of accounting on financial results. Changes in accounting, without a change in the business, may lead to results not supported by changes in operations. For example, change that allows for earlier revenue recognition provide new insights about growth, risks and claims on future cash flows. For example, bringing leases onto the balance sheet provides better information about a company's obligations, can affect valuation, may change company behavior. For example, granting fewer stock options when options are treated as expense. Investors and other stakeholders might make suboptimal decisions if they cannot interpret the financial statements. This underlines the importance of financial statement analysis. How to analyze financial statements. Before we discuss the financial statement analysis process, let's do a quick recap of the financial statements. If you need more information on the financial statements, you can check out other videos on the channel where we covered financial statements in depth. Income statement, also known as the profit and loss (P&L) statement. It shows revenues, expenses, and profitability over a specific period. Major income statement items include revenues, sales, cost of goods sold, COGS, operating expenses, net income. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It shows assets, liabilities, and shareholders' equity. Cash flow statement. The cash flow statement tracks the inflows and outflows of cash during a specific period. It is divided into operating, investing, and financing activities. Financial statement analysis process. At the Accounting Analyst, our process for analyzing the financial statements is as follows. First, we ask and answer some relevant questions. I will give examples of these questions in future videos on analyzing each of the financial statements. Next, we perform common size analysis of the financial statements. Common size analysis is a process where each financial statement item is expressed as a percentage of the same item or as a percentage change over the same period of time. There are two types of common size analysis: vertical analysis and horizontal analysis. For vertical analysis, income statement items are expressed as a percentage of revenue, and balance sheet items are expressed as a percentage of assets. For horizontal analysis, changes in income statement and balance sheet items over time are compared for unusual movements. Ratio analysis is the next step in the financial statement analysis process. We did a previous video on ratio analysis, so you can refer to that video for an in-depth discussion of how to perform ratio analysis. We use financial ratios to assess a company's operating results and financial health over time. Major income statement ratios include gross margin, which is revenue minus cost of goods sold, divided by revenue; operating margin, which is operating income divided by revenue; net profit margin, which is net income divided by revenue; earnings per share, EPS, which is net income divided by number of outstanding shares. Major balance sheet ratios include current ratio, which is current assets divided by current liabilities; debt to equity ratio, which is total liabilities divided by shareholders' equity; return on assets, ROA, which is net income divided by average total assets; return on equity, ROE, which is net income divided by average shareholders' equity. Major cash flow ratios include operating cash flow ratio, which is cash flow from operations divided by current liabilities, free cash flow, FCF, which is cash flow from operations minus capital expenditures, cash flow to net income ratio, which is cash flow from operations divided by net income. Interpret results and integrate from the 3 financial statement analyses. The next thing to do is interpret the results of the analyses and integrate results from the 3 financial statement analyses. Trend analysis, which looks at changes over several years, should be used to help interpret the results. Trend analysis should be done over at least 3 years to get meaningful results. Comparisons should also be made against the industry and against competitors. Differences in business model and accounting policies should be taken into account when making industry and competitor comparisons. Qualitative analysis. Financial statements are not just numbers. Qualitative aspects of financial statements should also be reviewed as part of financial statement analysis. Qualitative analysis includes reviewing management's discussion and analysis, MD&A, assessing the company's competitive position and market share considering the quality of management and corporate governance, and evaluating the company's strategy and future growth prospects. Summarize in a report. Finally, you should prepare a report summarizing your findings. This report can be presented to the different stakeholders. Financial statement analysis is important for investors, analysts, and management to evaluate a company's performance and financial condition. By utilizing horizontal and vertical analysis, calculating key ratios, and interpreting the results, you can derive meaningful insights and make informed decisions. Comprehensive financial statement analysis requires a holistic approach, combining quantitative analysis with qualitative assessment. It is important to look beyond the numbers and understand the underlying business dynamics. While financial statement analysis provides valuable insights, it should not be used in isolation. Rather, it should be part of a broader investment or business decision-making process that considers other factors such as economic conditions, industry dynamics, and company-specific factors. Take your time to think through your analysis, and make sure you can connect all the dots. It takes time to learn how to do financial statement analysis. It's not something you will learn overnight, but once you grasp it, you will find that it's an invaluable tool in making investment decisions and in advancing your professional life. That is it for this video. Thanks for joining me and hope you found the information useful. Remember to like, share and subscribe, and ring that notification bell to get new videos as soon as we publish them.